Learning Objective 4 is the most complicated we'll do in this lecture, and it's where we have 2 rounds of funding and also an option pool. So we're just stacking complexity on the scenarios 1 and 2. Now, the difference here is that we, at the time of financing, know that we'll need more money. So the venture capitalist who is in Series A will put in $1 million and they still want to make their rate of return. But they also want to contemplate that there will be another round in year 3. And that round will be for another $1 million. And that venture capitalist will expect to make 25%. Now, the reason I'm saying it in this fashion is that the venture capitalist from the Series A does not want to have any dilution of their return. So the calculation we're going to do is complicated to provide for the same rate of return for the venture capitalists for Series A, even though we have yet to raise the second round of financing. And we'll show you how that works with numbers. So that's the main difference from the Learning Objective 3, where we had 1 round of funding plus an option pool. All right, so we'll hop back into Excel. All right, so here we'll see the same information as we've seen before. The top is just the set of assumptions. And step 1 is determining the value using the venture capital method. And I'm going to skip doing it again because it's the same. So we had this sequence that got us to the valuation of $16 of value for every dollar of profit. This section here applies the rate of 16 times earnings to get to the valuation to our hypothetical harvest point in year 5 at $1 million income, corresponding to 16 million of market value. This section here is for the Series A venture capitalists. They still want to put in $1 million. They still want 50% return in 5 years, and that means that the value at the time 0 is 2.104. Next is we're going to say, well, what happens now with this introduction of the complexity of the Series B financing? All right, so here's where we get a little trickier. So we say, okay, at the time of exit, who owns the company? At the time of exit in year 5, we're going to have the common shareholders, the option holders, the Series A, and the Series B. So let's look at how the money is divvied up at that point in time. The Series A investors put in $1 million, and the required return is 50%, and they want a 5-year holding period. So this figure here is the future value of the 0.5 or 50% rate of return for a period of 5 years, with 0 payments because there's no cash flow during the years. And then the beginning balance of $1 million means that at the end of year 5, they expect to get $7.5 million. That's the same as a spin or a scenario 1 and scenario 2. Next, the Series B people. This is the new one, right? So they put in $1 million, 25% expected rate of return, 3 years, because this year's 3, 4, 5, 3 years. So that future value is future value at 25% for 3 years, 0 payment, and $1 million initial investment means that money should be worth 1.953 in year 5. And so now we have a total of how much is going to be owned by the VCs for the Series A and B. Now we know the value of the company is estimated at 16 million. So this number here is the amount that 7.59 represents of 16. So the VC Series A will own 47.46% as in before, and then the Series B will own 12.21 in order to achieve their target of 1.9. So combined they own 59.67, which means we still have to take care of our option pool of 20%, which means the founders are now down to 20.33%. That's life. Golden rule. All right, so now the part gets a little tricky because we have 2 financings. So we know that after the Series B, the ownership of the common is this 20.33. If the number of shares outstanding is 2 million, then the total outstanding as of the end of year 5 will be this number. It's 2 million represents 20.33%, which means the total outstanding are 9.836 million shares. Now let's back off to Series A. In Series A, there was no financing yet of the Series B people. So what is the ownership of the founders? They own the 20.33, but instead of dividing it by 100%, we have to subtract out what is owned by the, or reserved in a way, for the Series B. So that means that at the end of Series A, the ownership position for founders is 23.16. Now that will be diluted down at year 3 when we take in more shares. The shares owned by Series A, still 2 million. 2 million divided by 0.2316 is 8,635,000. All right, so that's Series A for the owners. So this section here represents the ownership interest for the founders. The next section is for the Series B people, right here, this section. Notice that they weren't in Series A, so they're not in this column whatsoever, but they are here. At the end of Series B, they're going to own the same 21% up here, and 12.121% times the 9 million right above it represents that they will have 1.2 million shares. If they buy those shares for $1 million, then the price per share, and they're in the new money, the price per share is $1 million divided by the shares they got, which is the 1.2, leading to a valuation of 0.83. Next, we look at the Series A investors. These are the original venture capitalists, and they are around for both Series A and B. So at the end of the period, they want to own 47% of 16 million. If they own 47% of the shares, and the shares are 9.8 million, their number of shares is 9.8 million times 47% that they own, which is 4,668,000. Now, backing to Series A, before the Series B was funded, they will own their share of 4,688,000 divided by the outstanding shares at the end of Series A of 8.6 million, which means they will have 54% of the shares. Notice that their shares don't change, similar to here where the ownership of the shares for the founders don't change. So these stay static, but the percentage changed because in Series A, there's no B investor yet, so no shares issued to them. And then as the B shares are issued, then the denominator gets bigger, and therefore the ownership percent for both the founders and the Series A will drop. And the price per share, again, Series A sets the price, and they paid $1 million for 4,668,000 shares, and that is a price of 21 cents a share. Now we're ready to do the cap tables, but there are two, because there are two different fundings. The first is Series A, and I'm just pulling numbers from above again, just to put it in an orderly format. At the end of Series A, we know, first of all, this number, 8,006,000 represented the shares right here that were outstanding. And we got it by 2 million shares owned by the founders is equivalent to 23%. All right, so if that is known, then this number is a 54% owned by Series A, and 54% of the 8,006,000 is this. So 54 times the 8 million is this number of shares, which is what we saw previously. The common stock, we know this 2 million, that's been the same all the way through. And then the option pool, notice, is bigger than 20%. Why? Because in the Series A, we're going to dilute that down to 20%. So we have to have it a little bit higher than 20% during Series A, so that as it goes to Series B, it drops down to 20%. All right, so the dollars per share, we set the price here based on the financing of the VC for Series A at 21 cents. So the entire set of shares are at that price. And so this set the post-money valuation of the company at 1.849 million. And notice this is lower. It's lower because we're going to need more money coming from the Series B later on. All right, so that's the Series A. And it'll probably make more sense when we unroll Series B. Series B happens, and this purple row shows up. And this is where we get money from the Series B VCs, and they will be putting in this money, the $1 million, and get 1.2 million shares. So we're going to see this financing. So everything is the same, 4.6 to 1.9. The only change is this number, 1.2. When you add the 1.2 to the numbers here, we get to this number, 9,000,008, which is exactly the same as what we saw up here, the 9.8. So it's all kind of squaring up nicely. So if we have 9.8 million shares outstanding, and the VC still want their 47% because they need that to achieve their 50% return, then that's what they'll get. They end up at 47%. Series B ends up at 12, and that's what they need to get to the 1.9 million that their valuation's worth at harvest. And then the option pool gets to 20%, and the leftovers, hate to say that, goes to the founders. The price per share based on the new money was this 83 cents, and we price all the shares at that price. And so we end up with this set of valuations at a post-money of $8.2 million. And notice that we're upticking to 8.2 on the way to 16. When we grow our business further to year 5, we're going to grow that 8 million up to 16. All right, so then that's the complex scenario of 2 rounds of financing and an option pool, with the assumption that everyone knew this was necessary at the time of the initial offering. Now you might ask, well, what if they don't know? Well, if they don't know, then the VCs who were in Series A and the owners and the option pool will all be diluted equally, and they all start dropping. If that were to occur, chances are the Series A investor will not achieve their target rate of return unless the other assumptions are also moved up, namely the income and or the multiple, the earnings multiple. This is the set of shortcuts from the book, and one talks about the second round acquired, and this is the Series B investors, and using this formula here, we get exactly the same 12.21%. And the first round, the Series A, using their economics here, we get to the 47% that they own at the end of the harvest period. The founders had the 20.33%, that's their ending position, and total shares is the 9.8 million. So these formulas work, but I find them a little cumbersome and almost impossible to just look at and see if they make sense, whereas the spreadsheets kind of help you figure out the numbers more logically. Next is a scenario of all the outcomes, and we can look at it better on Excel. And so here's scenario 1, 2, and 3. Scenario 1 is one funding round and no option pool. Notice that the founders get 52%. I'll just highlight that. And let's pick a new color. Let's pick blue. So the founders get 52. In the second scenario, when we have to make room for an option pool, they drop to 32 because the 20 comes from them, essentially. Then in scenario 3, this should be 3, where there's a Series A and a B, they drop to 23% after the Series A, and then they drop further to 20.33 after the funding of Series B. So one thing is clear, the founder share just shrinks, whereas the VCs, particularly the Series A, they stay at 47%, 54, but that's only because it's the intermediate result, leading to, guess what, 47%. So this whole sequence was designed so that the Series A investors would accomplish their required rate of return of 50%, which needed 47%. The Series B, they were non-existent in the first 2 scenarios. In the third scenario, they were non-existent in the Series A, but they come into the picture in the Series B financing in this scenario. They come in with $1 million. They buy 1.2 million shares that gets them 12% of the company. And the reason that's important is at the very end, 12% of 16 million gets them to their target number of 1.9, which gives them their yield of 25%. The option pool is just sitting pretty. They're at 20%, they're a little higher than 20, and they drop back down to 20. This is the money we set aside to attract employees and managers to come join the company. So summarizing chapter 11, it's very important because we covered the essential topics of the venture capital method and the derivation of cap tables through multiple rounds and through the provision for an option pool. The capitalization tables, quite simple for the first scenario. There's no pool, no additional financing. So it looks like a pretty straightforward application of the VC method. The scenario 2 was more complex because the money for the pool is set aside all from the founder's share. And that's because by the term sheets, the venture capitalists will make the founders fund the option pool prior to their entry into the ownership. And in scenario 3, even more painful for the owners, we have to provide dilution for the Series A, the Series B, and the option holders. And in this scenario, as you recall, the ownership interest drops to 20%. So an owner group would start with 100%, and by the time we get to the scenario 3, they're down to 20%. Welcome to venture capital. And so some general comments are that the high discount rate dramatically increases the VC ownership percentage. And we saw this very clearly in the differences between VC for Series A and VC for Series B. A required 40% required return, and B required 25%. Next, the stock option pools are important, but the dilution is borne by the owners. So I suppose that's fair, if that is one way to look at it, because you're going to need that pool to be set aside for the benefit of the company and the achievement of the goals. And you might say, well, why doesn't the venture capitalists share in the burden? Well, because their pricing is based on what share they need to achieve their return. So to have them bear part of the pool would hurt that return and therefore not achieve their investment objectives, and therefore no investment. He or she with the gold makes the rules. And finally, the longer the holding period, the lower the ownership of the founders. And so often we see that it only takes 1 or 2 or at most 3 rounds before the majority ownership of the company is no longer in the hands of the founders. It's now in the hands of the board, as primarily controlled by the venture capitalists. All right. So that's our lecture for the VC capitalization tables, and I'll see you in class. Bye-bye.